The Tax Cuts and Jobs Act of 2017, like any change of our tax codes, has supporters and critics. There are winners and losers. It makes taxes both simpler and more complicated. Today, we are very happy to have tax attorney Russell Staniland to help us understand some of the most important changes for we folks who live, work, and own businesses in San Mateo County. Russ is not only a certified specialist in taxation law, but is also a CPA and adjunct professor of law with over 25 years of experience. Welcome to Take Notice, Russ.
Thank you, Dan. It's a pleasure to be here.
So Russ, first of all, there is now a limit on the deductibility of state and local taxes. How will that affect people in California?
That is a very major change in the tax law. In the past, we were able to take a full deduction for all of our state and local taxes. It's now limited to $10,000. In San Mateo County, we live in one of the highest tax districts in the United States. However, the effect on most people is going to be a whole lot less than they think, because we have something called alternative minimum tax. And I'm not going to get into the details on that, but for alternative minimum tax, state and local taxes were not deductible at all. And therefore, if you eliminate the deduction, it has a relatively small effect on a lot of people. And if you want to see if you've been paying alternative minimum tax, because most people don't realize they're paying it, look at line 45 of your Form 1040. If there's a number on that line, you're paying alternative minimum tax, and limiting your state and local taxes will not have as great of an effect on you.
So is this a good thing or a bad thing for us?
It all depends. I wish I could give an easy answer for that, but there are no easy answers in this new tax law. The official name is the Tax Cut and Jobs Act. I think it really should be called the Tax Attorneys Full Employment Act.
I like that one. Good one, Russ. So good. So the next question, there's a new limit on deductibility of mortgage interest. What does that do to people here who have large mortgages?
Well, again, it depends on your facts and circumstances. We live in one of the highest housing cost areas in the world in San Mateo County. And for people who had their mortgage in place on December 15th or December 14th, 2017, it will have no effect. You are grandfathered in. And it will have an effect on people who had a home equity line and are paying interest on that. In the past, you could deduct the interest on up to $100,000 of your home equity line. That has completely been eliminated. And it's not grandfathered in.
Yeah, I have a little home equity, so that's going to maybe affect me. So what happens if someone refinances their mortgage?
Again, if you refinance an existing mortgage and don't take more money out, if you just refinance the purchase price of your house, then you can still deduct the mortgage.
Oh, okay, well that's good to know.
Yes.
So in the past, everyone got a big tax break on sale of their residence. Is this still going to be the case?
Good news here. Yes, you still get to exclude the gain on, or up to $250,000 of gain on the sale of your personal residence if you meet the other requirements. And a married couple filing jointly gets to eliminate $500,000, $500,000 of gain.
Wow, so that's a little bit of good news. So good to hear that. And please tell me about the child credits under the new law.
Yes, there is a very good benefit available now. There is a $2,000 credit per child, and $1,400 of that credit is a refundable credit. What that means is, even if you don't, a credit normally reduces your taxes dollar for dollar. If you're not paying any taxes, a credit does you no good. If the credit is refundable, that means you get a payment from the government, even though you paid no tax. So it's $1,400 per child, and anybody making $400,000 a year or less gets the credit.
Good.
It's a wonderful credit.
Yeah, that's good. Good to hear. So I understand there are other changes to maybe alimony and medical expenses. Could you explain a little bit about that for our audience?
Yes. Good news on medical expenses. In the past, if you were under age 65 and you had medical expenses, you could only deduct them to the extent they exceeded 10% of your adjusted gross income. So if your adjusted gross income was $100,000, you lost the first $10,000 of your medical expenses. They've now reduced that to 7.5%. So it's easier to get the deductions, and they are still available.
Great. Are there other deductions that we should be made aware of?
Some deductions have been eliminated. For instance, miscellaneous itemized deductions. People who had my fee for preparing tax returns used to be deductible. No longer the case. If you pay a financial advisor for their advice, it used to be deductible. That's no longer the case. They've also eliminated the casualty loss deduction. In the past, if you suffered a significant loss through fire, theft, or other casualties, you were able to deduct that. That's no longer available.
So a little bit of good news, a little bit of bad news.
Yes.
So I've read, and of course the old saying is that a little bit of knowledge is dangerous, but I've read that one strategy is to lump Schedule A type deductions into a specific year. For example, say you have a major surgery that exceeds a 7.5% level. That might be the year to make your charitable donations or contributions?
That is a very good strategy. Try and bunch your deductions all in one year if possible.
So that's a story on medical expenses. How about the story on alimony?
Oh, very large changes in the law regarding alimony. In the past, the ex-spouse paying alimony got a deduction, and the ex-spouse receiving the alimony had income. Under the new law, there is no deduction for the payer, and it's not income to the ex-spouse receiving it. However, that law doesn't take effect until January 1st, 2019. All the other laws are effective on January 1st, 2018. I'm not sure why they chose to delay it. I like to think that it's not because one of the senators was in the middle of a divorce.
My thoughts exactly. Lastly, let's shift our attention to businesses. The Tax Cuts and Jobs Act has some benefits, both large and small, as we've already discussed, but we know corporate tax rates have been lowered. What are some of the changes that benefit small businesses? Because I've heard that large corporations are getting, the bulk of this benefit. So are small businesses actually getting a benefit?
Well, you're absolutely correct that corporations get the bulk of this benefit. This law does not comfort the afflicted and afflict the comfortable. It benefits corporations tremendously.
Wow.
However, there is a very good break for smaller businesses. These are, the bill refers to them as pass-through entities. A pass-through entity is an S corporation, a limited liability company, and also under the new definition, it's an unincorporated business, sole practitioners. But if you have qualified business income, you can take a deduction for 20% of your income. You effectively pay tax on 80% of your income. And the devil is in the details on this one. This is incredibly complicated, and we don't know how the law is going to be interpreted right now. Qualified business income includes a lot of income, but it excludes a lot. And there are limits on the deduction. One of the limits is you can only deduct up to 50% of the salary and wages you pay. If you don't pay salary and wages, you don't get the deduction, unless you have major assets, very expensive depreciable assets, and then you can get the deduction. If you're one of the prohibited professions, you don't get the deduction. Lawyers are a prohibited profession. Accountants are a prohibited profession. Actuaries, performing artists, and athletes don't get it. And so I've got two of the prohibited professions. Does that mean I have to add 20% to my income? I don't know. But one of the big question marks is, does it apply to rental income? Because a lot of people in San Mateo County own rental property. And the answer is, we don't know. The bill originated in the House of Representatives, and the committee that drafted the bill issued a report They clearly said it's available for rental income. But when the Senate got hold of it, they changed the law tremendously, and their committee report doesn't address the issue at all. So we're going to have to get some clarification on that.
Chaos and confusion.
Yes.
Sounds like you're going to be very busy for the next couple of years.
Very busy.
Well, this is clearly a very complicated topic, and changes will continue to phase in for the next couple of years. The IRS will be figuring out how to implement the new rules, and no doubt attorneys and CPAs will be paying close attention. Our producers at Take Notice will be paying attention too, and we'll continue to bring in experts to explain, clarify, and simplify as much as possible the changes that affect all of us here. My thanks to Russ Staniland for joining us today and for your support of Take Notice, locally produced and locally focused. Be sure to like and share this video and send your suggestions for topics to Take Notice at mctv.tv. So until next time, I'm your host, Dan Lawson, and try not to have an excessively taxing day.